Hello, this is Michael O'Brien and welcome to another video in our series on mortgage and foreclosure issues in Oregon. If you are an Oregon homeowner concerned with staying current on your mortgage, then this series is for you. Hit the subscribe button and you'll be alerted when we drop new videos. Let's get to this one. Today we're going to talk about mortgage accounting. I'll be giving you 3 important things to know to help you decipher that mortgage statement you receive every month. Your home is your biggest asset, and besides your family and maybe your pet, it's probably the most important thing for you to protect. Your mortgage payment is likely the largest bill you have every month, sometimes the most difficult bill to pay. If you slip at all in making a payment, it gets really hard to determine where you're at. So here's thing to know number 1. The loan documents control the payment, not the statement. Your monthly mortgage statement may be wrong, and it often is wrong when people fall behind on their payments or the loan is service transferred. So the first thing you have to do is locate the loan note and the deed of trust from that large stack of papers you signed when you bought the home. How your payments are applied is controlled by those loan documents. Now there's many variables that affect how much you pay each month and therefore to establish whether you're current or not. Things like, do you have a fixed rate loan or a variable rate loan? If it's a variable rate loan, is it tied to a standard like the prime index or LIBOR? What is the margin which gets added to that index to come up with the actual interest rate? Does the rate change monthly? Does it change semi-annually? Does it change annually? Do you have a fully amortized loan, or is it interest only that resets after 5 to 10 years? The answer to each of these questions will determine whether the payment amount demanded on your monthly statement is in fact correct. When a loan is service transferred, meaning the company to whom you make the payment is changed, that is a hurdle that oftentimes causes the accounting to trip up. If your loan payee changes, pay very close attention to the mortgage statements before and after that date. Thing to know number 2, payments you make are applied to the oldest payment due. Some exceptions exist, but for a vast majority of people, the mortgage payment is applied not to the month in which you make the payment, but to the month in which it is due. Here's an example. It's January. You make your payment of $1,500 on time. Great, you get laid off in February and cannot make the payment. In March, you start collecting unemployment and you make a payment. But because of how mortgage accounting works, the payment that you make in March is applied to the oldest payment due. In this case, that would be February. When you get your April mortgage statement, it shows you're due for March, which you know isn't right because you paid March. But not so fast. The lender would be correct. The payment you made in March was applied to February, and you are in fact due for March. To make it even more complicated, let's turn to the third thing to know. Partial payments don't get applied. These are some deep weeds, but here's the thing. If you pay less than a full mortgage payment, the loan servicer is not going to apply your partial payment. Instead, they're going to hold on to your money until they have enough to make a full payment. So let's jump back into that scenario we were just discussing. It's now April, and you cannot afford to make a full payment, but you want to do your best, so you send in $750. Because this is only half a payment, it is not applied to your loan. When you get your mortgage statement in May, it will show you're due for March and April and now May. In May, you're still struggling, but you can make another $750 payment. The loan servicer cashes your check, but notice what happens here. The money that you pay in May combines with the money you paid in April, slides up to the payment due in March. So in June, you get a mortgage statement that indicates you're due for April, May, and now June. And based on the analysis we just went through, the loan servicer is right. All right, there you have it. 3 very important things to know to help decipher mortgage accounting. Number 1, the loan documents control, so you have to locate them first. Number 2, payments are applied to the oldest month due, not necessarily the month in which you pay them. And number 3, only full payments are applied, not partial payments. If you've made it all the way through this video, here's the virtual pot of gold. Call my office, mention the video, and my staff will set up a phone conference with me at no charge to you, where we can talk about your specific situation. Thank you very much. Take care.